Hi, all right, Gabriel Josiah here again. In this session, we are diving into one of the most powerful tools in financial analysis, the debt to equity ratio. It's more than just numbers. It's your ticket to understanding a company's financial health, risk profile, and strategic leverage. Whether you're gearing up for exams or tackling real-world challenges in the office, this video breaks it down in a way that is simple, practical, and actionable. So sharpen your pencils and prepare to take notes like a pro. And let's dive into this ratio very practically. Okay, so let me share my screen quickly as we look into this powerful financial metric. I've got me as usual, and let's discuss this ratio. Okay, debt to equity ratio measures the relationship that debt has to equity, capital of an entity. So it somehow looks like the gearing ratio, but you're looking at how many times the debt covers equity. The gearing ratio looked at the percentage of debt to equity, but the debt to equity ratio is looking at how many times the equity is in relation to debt. So it's calculated as debt divided by equity, and not as a percentage, but how many times the debt covers the equity. It's a financial leverage ratio like gearing ratio that compares the company's total liabilities in terms of debt to its shareholders' equity to see how many times it's covered. It indicates the relative proportion of debt and equity used to finance a company's assets or investments. This is very important. So a higher debt to equity ratio suggests that the company relies more on borrowed funds, which can imply greater financial risk, like we saw in the last class or last video in the gearing ratio, while a lower ratio indicates a more conservative approach to finance. So this is a variant formula. We'll be looking at briefly the example of how many times or how to calculate this ratio. So as you can see on the screen, let's go with the total debt of the company. So we have the preference capital that we calculated in the last class, which is 100 million. So we pick that. We go post it in our Excel. If you have your calculator, just follow me closely as we do the plus and minus. Okay, so we have the preference capital. So let's go pick the long-term capital. So we have the bonds and the bank loan, which is on the screen, and it's 450 million naira respectively. So 300 million for bonds, 150 million, 300 million, I beg your pardon, for bank loans, and bonds payable is 150 million. Don't forget, we are not using deferred tax liability, as this is not a borrowed or fund. It's not a borrowed fund. Take note of that. We've explained that graphically in the last video on the gearing ratio. Okay, so let's take our total equity, which is 1 billion naira, our total equity, which is 1 billion naira, and that is graphically on the screen. So our total equity is exclusive of the debt element. It's exclusive of the liability element. So now let's calculate our debt to equity ratio. Don't forget, it's in times. We want to say how many times the debt is of the equity. Debt is in relation to equity. So our debt to equity ratio is calculated as 550 million. 550 million to our 1 billion. We have it as 0.55. So 0.55 is to ratio 1.00. So it means our debt element is 0.55 or half of the equity element. Half of the equity element. So what does that mean? What does that mean? It reflects how much debt a company is using to finance its operation relative to its equity base. So not in percentage terms now. As the debt is not up to 1, showing equity, if it's up to 1 in this calculation we've just done, we see that the debt is equal to equity, or it's lower than equity, which is advisable. Even though it's above 55 or above half, it's still advisable to keep the debt moderate, even though from 55%, we're looking at it as going high. But then for expansion purposes and to generate revenue, it's good to take some risk at times. So a higher ratio indicates increased financial leverage. So where it's above 1, maybe twice the equity element, then it's riskier, it's critical, meaning that a significant portion of the financing comes from debt, while a lower ratio suggests a reliance on equity funding, which is better for the shareholders of the company. The implication is that a higher debt to equity ratio implies a greater financial risk for the company, as it must service its debt obligation or obligations regardless of its earnings. And that's critical because the earnings are where profits are distributed. So where servicing of debts has got the chunk or the significant amount of the earnings, then the shareholders have nothing to go home with. And this is very critical. So this can be particularly concerning in economic downturns where cash flows may be strained, like we just described earlier. So conversely, a lower debt to equity ratio indicates lower risk or moderate risk, which may appeal to conservative investors, shareholders, equity owners, ordinary shareholders, but could also suggest underutilization of financial leverage to grow. Yeah. So what are the cause and effect? A high debt to equity ratio is caused by aggressive financing strategies, expansion efforts funded through debts, or lower equity due to retained losses or shared buybacks. And the effects is clear. Increased risk of financial distress where you have high debt to equity ratio, higher interest expense, and potential difficulty in raising additional capital. While a lower debt to equity ratio is caused by conservative capital structure. So like we saw in shadow 2, we have 0.55, even though it's not low, in my opinion, it's moderate. Also, it causes reliance on equity financing, which is good, or accumulation of retained earnings, which is plowed back into the business, and maybe there was no distribution of profit or dividend to ordinary shareholders to grow the business. So these are the likely causes of a low debt to equity ratio. While the effects include greater financial stability, lower interest costs, but potential limited growth opportunities, if not leveraging debt very effectively. So balance is the key. In conclusion, the debt to equity ratio is a vital measure of a company's financial leverage and risk profile. So by comparing total liabilities, which is debt, to total equity, shareholders can assess the level of debt financing in relation to the shareholders' equity. Like we saw in the example, 0.55, half of the equity is a component of the debt, 0.55, which is reasonable in my opinion. While balanced, like I said, a balanced debt to equity ratio is crucial for ensuring financial stability and growth potential, allowing the company to navigate economic challenges while optimizing its capital structure. So it's essential to have some element of debt to leverage on this to grow, but then balance is key. So as chartered accountants, this skill of balancing our debt to equity and the capital structure of the firm, it's very important. It's a very key skill chartered accountant must employ and deploy. Very, very, very important. So please take note of that. And that's a wrap up on the debt to equity ratio. Whether you're a student preparing to ace your exams or a finance professional navigating high stakes boardrooms, mastering this ratio is non-negotiable for your success. If you found this video valuable, don't forget to like, share, and subscribe. And if you have questions, comments, I would like to hear your thoughts. Please share them in the comment section. Don't forget to join the community of accounting and finance enthusiasts striving for excellence when you subscribe to this channel. Together, let's conquer financial ratios, one calculation at a time. Stay tuned for more insightful content. Until next time, stay curious, stay sharp, stay financially savvy, and keep growing. See you in the next video. And until then, bye for now.